Hello friends, in the series on the income tax cases, today we will discuss the case of Shri Infrastructure Finance Limited versus Assistant Commissioner of Income Tax. This case has been reported in 105 ITR Tribunal at page number 371. The matter has been decided by Kolkata ITAT A bench and the date of the judgment is 22nd May 2023. In this case, the assessee is a non-banking finance company, and in case of non-banking finance companies, generally there are a number of the bad debts. When assessee filed the return of income, the assessee claimed some amount as a deduction for the bad debt. When the assessment proceedings were going on, the assessee realized that there were some more bad debts which are not recoverable. So the assessee claimed some more amount as a bad debt in the assessment proceedings which were not claimed at the time of filing of the return. There is a very famous case of Supreme Court of Gupta, India, which says that the assessee can claim an additional claim only through the revised return. So the assessing officer did not allow this further bad debt. The assessee went to the CIT appeal and CIT appeal allowed this bad debt which was not claimed in the return of income, because as per the Supreme Court judgment also, the appellate authorities, that is CIT appeal, ITAT, can allow the additional claim of the assessee which was not claimed by the assessee at the time of filing of the return. So assessing officer was justified in not giving that claim because it was not claimed in the return or the revised return, and CIT appeal was justified, and the ITAT also upheld the order of the CIT appeal for this respect. The second issue was that the assessee has made a number of the investments, because the assessee was a non-banking finance company, so it was in the realm of the business of the assessee to make the investments, but the assessing officer disallowed some interest expenditure for purchasing these investments. So as per the ITAT, it was the point that these investments were for the business purposes, so the interest amount which has been paid on the loans taken for purchasing these investments should be allowed. There were two more issues. One issue is that in this case, the assessee has transferred 20% of the profits to the special reserve, which is to be maintained by the non-banking finance companies under section 45 IC. It was the point of the assessee that this amount has to be transferred as per the statutory provision, so it should be allowed to the assessee as an expenditure. But the ITAT held that there is no doubt that this amount is to be transferred as per the statutory provision of the RBI Act, but this is not a charge on the profit, this is an appropriation of the profit. So this amount cannot be allowed as a deduction from the profits, and if this amount has been deducted, then this amount should also be added for calculating the book profits under section 115 JB. One more issue was there, as all we know that in case of non-banking finance companies, the assessee has to create the contingent provision at a specified percentage of the standard assets, and this is a provision like provision for bad debt. So the assessee has claimed this provision also as an expenditure by saying that this is also due to the statutory provision of the RBI Act, but the ITAT said that this is also a contingent liability and it cannot be allowed as an expenditure, and if it has been deducted from the profit, then while calculating the book profit under section 115 JB, this amount should also be added into the book profits. Friends, this case is very important. In this case, 4 issues were discussed. 2 were in the favor of the assessee and 2 were in favor of the revenue. At the end of this video, once again I am repeating the name of the case. The name of the case is Shri Infrastructure Finance Limited versus Assistant Commissioner of Income Tax, and this case has been reported in 105 ITR Tribunal at page number 37. The case has been decided by Kolkata ITAT A bench and the date of the judgment is 22nd May 2023. Thank you, friends.